Assalamualaikum warahmatullahi wabarakatuh, and a very good day to everyone. Welcome to our presentation on one of the most critical challenges faced by companies in the modern financial world, which is corporate financial distress. This is not just a topic from a textbook, it's a real world issue that affects global corporation, local SME, small medium enterprise, employees, investors, and even the economy at large. So, can you imagine a giant company with billions in assets suddenly falling to pay its debts, investors panicking, employees being laid off, and stock prices collapsing overnight? So that is corporate financial distress. And today, we are going to break it down for you in the most engaging and insightful way possible. So together with my teammate, my name is NAJMUDDIN AKMAL, AZAMUDDIN SHAMRI, AZIM bin HAIRUL, and ADHAM HAFIZ bin SAFREEN. We will explore not just what financial distress is, but also how it happens, what causes it, how to overcome it, and most importantly, how to avoid it. So let's begin. So let's go to the definition of financial distress. As I can show, I put three of financial distress, which is the condition or the sign or the lead. First is a condition where a company struggles to meet its financial obligation. They have an early sign, which is declining profit, rising debt, and negative cash flow, and may lead to bankruptcy or liquidation. So what is exactly is financial distress? So in simple terms, it's a situation where a company is struggling or falling to meet its financial obligations. Okay, this includes the inability to pay off loans, cover operating costs, or generate enough cash to keep the business running smoothly. But make no mistakes, financial distress doesn't happen overnight. It's often a slow burning crisis that begins with warning signs. As I said, it's declining profit, mounting debts, negative cash flow, or even loss of market share. So the end result, it could be anything from minor restructuring for full to full blank bankruptcy. And if not handled properly, financial distress can be the beginning of the end of any company, even the biggest names in industry. Okay, let's go to the types and categories of financial distress. So financial distress comes in different shapes and forms. Let's look at how we can categorize it. First, we have temporary versus distress. Temporary distress may arise due to short-term economic downturn or seasonal losses, while permanent distress signals fundamentals issue with the company's business model, leadership, or financial structure. Okay, then there is a liquidity distress, where a company has valuable asset but cannot distress signal fundamental but cannot convert them into cash fast enough to pay the bills, versus solvency distress, where the company's liabilities far exceed its total asset. So we also distinguish between operational distress, such as poor sales performance or production issues, and financial distress, such as overwhelming debt or poor credit worthiness. So recognizing what type of distress company is facing is crucial, because each one requires a different strategy to resolve it. Okay, now let's walk through the typical stages of financial distress. It usually starts suddenly, a decline in performance, maybe a dip in profits or rising costs. At this point, many companies try to cover it up or ride through the storm. But if the root issues are not addressed, things escalate quickly. So the second stage is involve liquidity challenges, missing supplier payments, struggling with payroll, or defaulting on loans. That's when alarm bells starts ringing. So next is come external intervention, which is creditors step in, stock prices crash, lawsuits appears, or regulators get involved. By now, the company's regulation or the company's reputation is damaged, and survival become uncertain. So finally, is no solution are implemented effectively, the companies can enter the crisis phase which possible outcomes like forced restructuring, receivership, or even bankruptcy. So what is important to remember here is that early initiation during the first two stages can save the company. The longer it is known, the fewer is the option. So in this slide, I've provided two examples, which is decline in performance, which is first is in our country, which is Malaysia, which is MAS, Malaysia Airlines. So MAS began showing signs of financial stress as early as the mid-2000s due to rising fuel costs, poor management decision, and tough competition. So profit margins shrank and losses become more frequent. So stage 2 is difficulty in repayment, which is, for example, is HAIRUL in Singapore. HAIRUL started missing interest payment in 2018 after its cash reserve depleted. Despite having assets, it could not pay debts. A classic sign of liquidity distress. Its bond were downgraded and panic spread among investors. So that's two examples that I can provide for this slide.
Now, let's take a look at what actually causes financial distress in companies. Financial distress can come from both an internal and external cause issues. Internally, poor management decision and taking on too much debt are common causes. If a company borrow more than it can handle, it may struggle with repayment. At the same time, external factors like inflation, rising interest rate, or global economic crisis can suddenly increase costs and reduce business income. When this issue combine, it becomes difficult to companies to stay financially stable. Next, how can we tell when a company is in distress? Let's look at the sign. One of the first symptoms is when a company starts delaying payments to suppliers or missing loan repayments. This shows that it's having troubles with cash flow. Another red flag is a sudden drop in the company's share price, which reflects a loss of investor confidence. Companies might also begin to downsize by laying off workers to cut costs. This all warning sign that financial health is declining. So, what happens if the situation continues and the company doesn't recover? The consequences can be very serious. First, investor may lose trust in the company, leading to a drop in stock price and difficulty raising fund. Credit rating agency might also downgrade the company, making future borrowing more expensive or even impossible. In worst case scenarios, company may go bankrupt or be taken over by other firms. Some might be forced to shut down completely, affecting not just the business itself, but also employees, suppliers, and wider economy. Let's now look at the real-world example of financial distress during a global crisis, which is the COVID-19 pandemic. During the pandemic, many companies faced sudden cash flow problems due forced shutdown and restrictions. Industries like airlines, tourism, and retail were hit the hardest. Global supply chains also broke down, making it difficult for businesses to get material or deliver product. Even strong companies struggle, showing that no business is truly safe from external shocks like a global pandemic.
Okay, let's talk about HAIRUL's background. HAIRUL is a company from Singapore that started in 1989. It focused on water-related technology, especially in treating and cleaning water. HAIRUL took on a very large project called SAFREEN, a water desalination and power plant. It cost about 1 billion to build. This was a massive investment for the company. HAIRUL was very popular with investors and the public. People saw it as successful and promising company, hence the praise market darling. Let's talk about HAIRUL collapse. HAIRUL owned a lot of money, almost $3 billion. This is a huge amount of debt for any company. The Whispering project did not make enough profit. It cost $1 billion to build, but it didn't earn back what was expected. This caused financial stress. Because of the financial trouble, HAIRUL was sued by some investors and business partners. Eventually, its shares were no longer traded on the stock exchange, suspended trading. Several investors or companies tried to help HAIRUL by offering rescue package or buying part of the business, but those deals didn't work out. So, what we can learn from HAIRUL crisis? HAIRUL borrowed too much money. If a company relies too heavily on loans and cannot repay them, it can quickly run into serious financial trouble. The tourism project was very expensive but didn't generate enough income. This shows how important it is to carefully study whether a project is truly worth the cost before committing to it. HAIRUL was criticized for not being open enough with investors about the company's real financial situation. Keeping investors informed build trust and help avoid legal or reputational problems.
Okay, now let's discuss the possible solutions for companies facing financial distress. The first and most common approach is debt restructuring. This means renegotiating the terms of existing loans with banks or creditors to extend repayment periods or reduce interest rates. By doing this, companies can improve cash flow and avoid default. And next, cutting non-essential costs is very crucial. Many firms often carry expenses that do not directly contribute to revenue, such as luxury office spaces or unnecessary marketing projects. During times of distress, these costs need to be minimized or completely removed. And another solution is seeking capital injection. This can come from existing shareholders, private investors, or even government-linked funds. For example, during the pandemic, several companies in Malaysia received government assistance to stabilize operations. And finally, appointing a crisis management team or financial advisor can help companies identify the root causes and implement a turnaround plan. These experts often bring fresh perspective and strategies that management may overlook. Overall, these steps are not easy and require strong leadership, but they can save a company from collapse. Now, moving on to prevention strategies. The best way to handle financial distress is to prevent it from happening in the first place. First, regular financial audits are essential. Audits help detect early warning signs such as declining profitability or increasing debt levels before they become critical. Second, companies should focus on building reserve funds. Just like individuals need an emergency fund, business also need liquidity buffers to survive unexpected crises such as economic downturns or pandemics. And third, conservative borrowing practices must be applied. Many companies collapse because they take on excessive debt without considering repayment risk. A good principle is to match the amount of debt to the company's ability to generate stable cash flows. And lastly, strong governance is the key. This includes having an experienced board of directors, implementing risk management policies, and ensuring transparency with stakeholders. Good governance builds trust and helps companies adapt quickly when facing challenges. If these preventive measures are consistently applied, companies are far less likely to experience severe financial distress. To conclude, financial distress is a serious issue that can affect any company regardless of size, reputation, or industry. We have seen that the causes can range from internal factors like poor financial planning to external shocks such as economic crises and pandemics. The impacts of financial distress goes far beyond the company itself. It affects employees, investors, suppliers, and even the stability of the national economy. This is why timely solutions like debt restructuring and effective cost control are so important. Moreover, prevention is always better than cure. Companies that maintain strong governance, perform regular audits, and build sufficient financial reserve will be better equipped to handle uncertainty. In short, financial distress is not the end of the road, but recovering from it requires quick action, strategic thinking, and also a commitment to transparency. And thank you for your attention. We hope our presentation has given you valuable insights into corporate financial distress.